All right, let's dive into one of the most talked about income strategies out there for options traders. Today, we're going to break down the options wheel strategy, step by step. Let's get right into it.
So let me just start with a quick question. How would you like to get paid for something you're already planning to do? I mean, what if you could collect cash right now just for agreeing to buy a stock you already love but at a cheaper price? Well, that's exactly the idea we're going to unpack today.
You know, if you're an investor who's after that steady, regular income, you've probably felt kind of stuck. On one side, you've got your classic slow and steady buy and hold. And on the other, you've got the super high-stress, high-risk world of day trading. The strategy we're looking at today, it aims to find that perfect sweet spot right in the middle.
And that strategy is called the wheel. It's a really systematic way to play the market, and it's all about generating regular income by stringing together a few key option ideas into a cycle that you can just repeat over and over again.
So what is it, really? Well, at its heart, the wheel is a process. It all starts with you selling options on stocks that you've already done your homework on, stocks you'd actually be happy to own for the long haul. This whole thing creates a cycle, or a wheel, that can spin off multiple streams of income, all from the same pot of money.
This right here, this is the entire journey laid out. It kicks off with selling something called a cash-secured put. Now from there, you might end up owning the stock, which then smoothly transitions you to the second half of the wheel, selling covered calls. And if those shares get sold, well, you're right back at the beginning, ready to start the cycle all over again.
Okay, theory is one thing, but let's make this real. We're about to walk through a super simple, step-by-step example. You'll see exactly how this wheel turns and, the important part, how it makes you money at each and every stage.
The very first gear in our wheel is the cash-secured put. And listen, the most important part of that phrase is cash-secured. It means you're not just selling some random contract into the void. Nope, you're actually setting aside the exact amount of cash you'd need to buy 100 shares of that stock if the trade goes that way. This is a massive, and I mean massive, risk management step.
All right, let's set the scene. We've got stock ABC, and it's trading at $50 a share. You like the company, but you're thinking, $50 a little rich for my blood. So you sell a cash-secured put with a strike price of $45. What does that mean? It means you're promising to buy 100 shares at $45 if the price drops to that level. And for making that promise, you get paid instantly. In our case, you pocket a cool $100 premium.
So from this point, one of two things is going to happen. Path number one. If stock ABC stays above your $45 strike price when the option expires, that option just poof, expires worthless. You get to keep the full $100 premium, no questions asked, and the trade is done. But if the stock price does drop below $45, you get assigned the shares.
Okay, so let's say you get assigned. You now buy 100 shares of ABC for $45 each, just like you promised. But wait, remember that $100 premium you collected? Since one options contract is for 100 shares, that's like getting $1 off each share. So this is the cool part. Your actual cost isn't $45. Your effective cost is only $44 a share. You just bought the stock you wanted at a discount to the price you wanted.
Now you officially own the stock, which means we can pivot to the second half of the wheel, the covered call. Since you own 100 shares, your position is covered. You're now going to turn around and sell someone else the right to buy those shares from you, but at a higher price.
So, to keep our example going, you sell a covered call with a strike price of, say, $48. And for doing that, boom, you instantly collect another premium, maybe $80 this time. You've now made money on both sides of this whole thing, first for just agreeing to buy the stock, and now for agreeing to sell it.
So we've seen the how, but let's zoom out a bit and really talk about the why. What are the real, tangible benefits that make this strategy so incredibly popular for people who are focused on income?
The advantages are pretty powerful when you see them laid out. You're constantly collecting these premiums, which creates a steady income stream. You're putting yourself in a position to buy stocks you already like, but at a price you like even better. And maybe the most important part, every single premium you collect lowers your cost basis, which is a huge advantage that can really boost your profits in the long run.
Okay, let's go back to our example and add it all up. Let's say your shares do get sold at that 48 strike price. You've literally profited at every single step. You kept the 100 from the put, you kept the 80 from the call, and you made $4 a share on the stock itself. Add it all up, and that's a total profit of $580 for one full spin of the wheel. Not bad. Now check out this quote from an experienced trader. It kind of flips a common assumption on its head. For a lot of people running the wheel, the main goal isn't actually to get the stock. It's to just keep collecting those premiums over and over. In their view, getting the shares is more of a backup plan, not the primary objective. But of course, no strategy is perfect, and none are without risk. To run the wheel the right way, it's just as important to know what not to do. So let's look at the 3 biggest traps that traders tend to fall into. And these come straight from traders sharing their battle scars. First off, if a stock drops, it's so tempting to sell more puts to average down. But if you do it too early, you can get a ton of your capital stuck. Second, going all in on one stock right at the start is just asking for trouble if it moves against you. And finally, using only one single metric, like delta, to pick your strikes. Well, that's kind of like driving with one eye closed.
And since we just mentioned it, let's do a super quick definition of delta. Just think of it as a rough probability gauge. So an option with a 0.30 delta has, roughly speaking, about a 30% chance of ending up in the money. A lot of traders will use this to pick strike prices that have a really high chance of expiring worthless, because that's the goal when you're just trying to collect that premium.
And this brings us to the single biggest, most important risk of the wheel, getting assigned shares of a stock, only to watch that stock just keep falling and falling and falling. You're left holding a bag, an asset that's just bleeding value. This is exactly why that very first step, choosing a high-quality stock that you're totally willing to own for the long term, is absolutely non-negotiable.
So we've gone through the mechanics, the pros, and the cons. The last question is really a personal one. Does this strategy actually line up with your financial goals and, just as important, your personality as an investor?
This quote just perfectly captures the mindset you gotta have. The wheel is not about hitting home runs. It is not exciting. It's a slow, methodical, almost boring process that rewards patience and discipline, not adrenaline. It's a game of hitting consistent singles and doubles, not swinging for grand slams. And really, that's what it all boils down to. The wheel forces you to ask yourself what kind of investor you truly want to be. Are you chasing that dopamine rush of a huge risky win, or are you trying to build a systematic process for consistent long-term income? There's no right or wrong answer, but the wheel is definitely firmly in that second camp. Hey, if you found this breakdown helpful and you want more deep dives into strategies just like this one, do us a favor and hit those like and subscribe buttons. Thanks for tuning in, and we will see you in the next explainer.